welcome to this explainer. Have you ever stared at a trading chart and just felt like you were looking at a completely chaotic, random mess of lines? Yeah, we've all been there. Well, today we are going to completely change how you view the markets, or actually decoding the institutional market logic that really drives price action. Think of it as a true trader's blueprint. Okay, let's dive into this and uncover the mechanics that the pros use every single day. To really get trading, we gotta strip away all those super complex indicators and just ask one remarkably simple question. Why does price actually move? I mean, think about physical gold for a second. If suddenly a massive wave of people desperately wants to buy gold, but there's only a limited amount sitting there ready to trade, what happens? Well, the supply drops, scarcity goes up, and the price absolutely shoots up. And the exact opposite happens when everyone rushes to sell. Price moves strictly due to the basic economics of scarcity. It really is that fundamental. And this brilliantly illustrates what happens when that scarcity translates onto a trading chart. We basically see two extremes. Over on the left, when massive buying steps in, it's because the major players see the current level as a total discount price. They literally buy up everything, which drives the price higher. Then on the right, when the price gets just way too high, it hits a premium price. Sellers step in mass to lock in their profits, flooding the market with supply and driving the price right back down. Your job as a trader, it's simply to identify these extreme areas. So here's our roadmap for today. First up, understanding supply and demand. Number 2, finding imbalance zones. 3, the first touch discipline. And finally, number 4, multi-time frame analysis. All right, let's get into section 1, understanding supply and demand. Now, what's really interesting about this slide is how abstract economic theory actually leaves visual footprints on our charts. Like, how do we spot exactly where the big banks and institutions left their massive orders? Well, we look for the anatomy of an institutional order, what we call an indecision candle. Picture a candle with large wicks on the top and bottom, but a really tiny body. That means the market paused, buyers and sellers basically fought to a complete standstill, and then, boom, a massive impulsive move followed. That little sideways pause right before the explosion, that right there is your supply or demand zone. That's exactly where those massive orders were accumulated. But okay, here is where so many beginners get completely trapped. You're going to start seeing these zones literally everywhere on your chart. But context is absolutely crucial. Market structure dictates everything. If the market is in a clear uptrend, making higher highs, you should only be looking to buy at demand zones. Make sense? And if you're in a downtrend, creating lower lows, you strictly sell at supply zones. Trying to catch a falling knife by buying a demand zone during a massive downtrend, that is just a guaranteed way to lose your capital. You gotta always trade in line with the trend. Moving right along to section 2, finding imbalance zones. Okay, so now that we know what a zone looks like, we desperately need a way to filter out the weak ones. This is kind of the secret ingredient that separates beginner setups from professional, high-probability trades. To filter out the bad zones, we validate them using 3 strict mechanical steps. Step 1, you find that indecision candle we just talked about. Step 2, you confirm there was a really strong impulsive move away from it. But Step 3 is the magic filter. You absolutely must ensure there is an open gap and imbalance between the wicks of the surrounding candles. If there's no gap, the zone is totally invalid. Scratch it. Let me show you exactly what that looks like. Just notice the clear difference between these two setups here. On the left, we've got a valid setup. See the literal gap? It's open space where the wicks of the candles do not touch each other. The price moved so incredibly fast that it left an open void, meaning buyers and sellers didn't even get a chance to efficiently exchange orders. Because of that, the market acts like a giant magnet, wanting to come back and fill that void. Now look at the right. The wicks are touching. That's an efficient market. The orders have already been completely filled. If you try to trade that efficient zone on the right, you are totally setting yourself up for failure. Which brings us to section 3, first touch discipline. So the crucial point is, supply and demand zones definitely do not last forever. They actually have an expiration date. Honestly, if you take absolutely nothing else away from this explainer, please remember this golden rule. Only trade the first touch. I like to think of a supply or demand zone kind of like a sponge full of water. When the market returns to that zone for the very first time, the zone absorbs the new orders perfectly, giving you a really nice high probability bounce. But every single time price comes back, more and more of those orders are depleted. So the very first time price taps back into your perfectly drawn imbalance zone, your win probability is at its absolute peak. It's fresh. But by the second touch, it becomes highly risky because, well, half the orders are probably gone. And by the third or fourth touch, forget about it. The zone is completely dry. The market is very likely to just smash right through it. So don't fall in love with the zone, guys. Use it once, take your profit, and move right on to the next fresh setup. But wait, what happens when you look at a chart and you see, say, 2 or 3 valid imbalance zones in the exact same area? Which one do you actually choose? Well, you look for the extreme zone. This is simply the furthest imbalance zone away from current price in that specific leg of movement. Because it sits at the absolute extreme, it naturally offers the best possible discount or premium. It's hands down the safest, highest probability place to set your limit orders. And look, if the extreme zone breaks, it usually just means the entire market trend is reversing anyway. Let's move to and see how this builds in section 4, multi-time frame analysis. So we have all our micro rules down pat. Let's zoom out and see how this builds into a complete big picture strategy. Because you really can't just stare at a 5-minute chart all day and expect to know what the broader market is doing. The sheer beauty of supply and demand is that markets are fractal. What that means is this theory is a totally universal language. An indecision candle followed by an imbalance. It looks and behaves exactly the same whether you're looking at a 1-week chart, a 1-hour chart, or a 1-minute chart. The core patterns literally never change, which makes this blueprint highly adaptable whether you're a patient, long-term swing trader or a super fast-paced day trader. To actually use this effectively, you need to employ top-down analysis. Think of it exactly like a GPS. The weekly chart, that's your world map. It shows you the massive supply and demand zones that are dictating the long-term trend. Then the daily chart narrows down your focus to, say, a specific state or city. And finally, the hourly or minute charts. Those are your street-level view where you actually execute your entry. So you're building the narrative on the higher time frames, and you're hunting for those precise sniper entries on the lower ones. And this top-down GPS approach also tells you exactly where you should be taking your profits. We call this zone-to-zone targeting. Think about it. If you buy at a demand zone, where is the absolute most logical place the market will reverse? At the next supply zone, right? So you just set that opposing supply zone as your target. This secures a massive risk-to-reward ratio, and perhaps most importantly, it keeps you from losing all your hard-earned profits when the market inevitably hits that supply and reverses right back down. It's really that straightforward. Just keep it simple and trade from zone to zone. Wow, okay, we've covered a tremendous amount of ground today. From the basic economics of scarcity to finding those crucial imbalanced indecision candles, enforcing the first touch rule, and zooming all the way out for top-down analysis. Remember, the market is not random. Not at all. It's a highly structured environment driven by real institutional orders. So leave you with this provocative thought. Next time you open a chart and see a massive, violent drop in price, are you going to see panic? Or will you simply see the market leading behind a beautifully imbalanced supply zone, just waiting for your first touch entry? The choice, and this entire blueprint is now yours. Keep learning, keep analyzing, and I'll catch you in the next explainer.